Welcome to the June 19th, 2017 Advance Report for McGowanGroup Asset Management clients. Thank you for joining us today. This is a powerful, brief report designed to bring you updates on the financial markets with actionable lessons for investors. We're going to start with Whole Foods, Austin-based Whole Foods this week. Taken out by Amazon. Oh my gosh. This company cash flows, by the way, we did our research, they cash flow at about $1.3 billion a year. The takeout price for Amazon, just under $15 billion, means Amazon's going to start with a cash-on-cash return, potentially at 7 or 8%. Plus the value of the two business synergies. Whole Foods has a new app that has been absolutely extraordinary in connecting with their customers and, yes, providing some discounts. The chain used to be called Whole Paycheck, but nicknamed Whole Paycheck. I'm sure Amazon's going to be able to figure that out. Here's a lesson. We look back here. This is $5 a share in the crisis. This is $40 back at the peak in 2005. That was essentially more than a tenfold gain from the price in the 90s. Then we go from 5 all the way up over 60, back to 30, and now taken private in the 40s. What an amazing success story, but notice the lessons here. There were plenty of times that you could get your butt kicked in Whole Foods if you overpaid. So lesson 1, don't overpay. There's always price risk. Next, crude oil. Wow. We had predicted last summer crude could fall below $40 a barrel due to the shale revolution, and it appears to be well underway with the low this week near $44 per barrel. OPEC may be in big trouble because those governments tend to overspend, and this is putting the crunch as the U.S. has an estimated 1 million barrels a day in new production coming from the shale revolution this year, on our way to energy independence, especially if you include liquid natural gas and natural gas exports. The TBill. Wow, look at this. This is all the way back to January. So this is year to date. We started with the interest rates actually below 0.5% on the TBill. The TBill follows the Fed funds rate dictated by the Federal Reserve, which was raised to 1% this week. So if you look at this chart, the chart is rates up. But what gives on the long market? Well, Janet Yellen raises the Fed funds rate to 1%, and look what happened to the 30-year U.S. Treasury. This is an important lesson for investors. The 30-year U.S. Treasury, this chart looks almost opposite, right? That's a flattening. Right here, we're at 2.8%. The post-election high, we actually reached 2 3/4 at the low this week, 2 3/4% on the 30-year Treasury. And if you look, the post-election high was near 3.2% on the 30-year Treasury. It had spiked from 2.1. Pretty rapid increase last year in the interest rates, now settling back down, even though the T-bill rate has gone up. This weekend's program at NetWorthRadio.com, we're going to cover strategy implications for investors, especially in fixed income and, yes, equity too. Join us at NetWorthRadio.com, and thank you for tuning in to this week's Advance Report. I'm Spencer McGowan, President, McGowanGroup Asset Management.